more or less all lenders have the same rates, at least within 0.1%. I sort of liken it to like if you want to go buy Apple stock. I don't say, Dean, what's your price for Apple stock? And then go to another financial advisor and say, what's your price for Apple stock? Because the market is giving you your price. In mortgages, the market is giving the lender their price or their interest rate.
Starting your route to retirement.
Hello, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group, your host of the Guided Retirement Show. Welcome to the Guided Retirement Show. Today, we have a very special guest, a friend of mine for a number of years. His name is Tim Kay. He is a branch manager for a company called Guild Mortgage, and Tim has been in the lending business for over 20 years. And I always get questions from people about refinancing a home, about a first-time home purchase, about buying a second home. And so we're so excited to have Tim Kay on the Guided Retirement Show. The conversation that Tim and I are going to have is going to open your eyes to a lot of things that you need to know when it comes to buying a home, selling a home, getting into your next home, how much money should you put down, all of that and more with my conversation with Tim Kay. Before we hop into today's episode, I want to remind our listeners and viewers that you can access the same financial planning tools we use for our own clients on your own time and all from the comfort of your own home. All you need to do is visit the link in the show notes and click the Start Planning button. From there, you can start building your retirement plan, no cost, no obligation. All right, we've got Tim Kay. He is the branch manager at Guild Mortgage in Overland Park. Tim, thanks for taking time to join me here on the Guided Retirement Show.
You're welcome. I'm happy to be here. Thank you.
You and I have known each other a long time, and the mortgage business has been your business for as long as I've known you.
I think I've been a lender since either 95 or 96, so 20 plus years.
Yeah.
Been a lot of changes in those years.
And you've seen a lot of changes in those years. I remember.
Oh yeah.
I remember back in. So you had the Fair Housing Act passed shortly after you got into the lending business, and you had all these crazy loans that were taking place back in the mid 2000s. Coming off of the .com bubble when stock markets crashed, and everybody's saying, "Well, just put your money in real estate. Put your money in real estate." Right. What was it like back then?
Oh, it was crazy. Honestly, back then, I probably could have made more money if I would have done those loans, but they didn't feel good, so I didn't ever do them, which actually worked out to be a blessing because they all but outlawed all those kind of loans, and they pretty much went away. And those of us that did good quality business are the only ones still around. There were stated income loans, stated asset loans, and like you could have a secretary that wanted to buy a big house and say she made $20,000 a month, and nobody would even ask. And it was just a minimum wage person, but you were acting like they made more. Or you could do pay option arms where they were negative amortizing. In other words, you weren't even paying the full interest. And so your balance, instead of going down, was actually going up every month by a little bit. But they said that was okay because house prices are increasing more than your house loan amount was going up. And so that was all well and good until about 2003 when all of that stopped happening.
Yeah, well, and so, yeah, what you're talking about, they called them, well, I called them liar loans.
Yes.
Right? Because, It's like nobody verified any of your income. They didn't verify your assets.
Stated income, stated asset.
Yeah. And, I think what led to the Great Recession, there was a number of different issues that were out there, but a lot of the lending standards in the housing market really exacerbated that Great Recession to a big degree. So let's go to one of the loans that you're talking about here.
We didn't even realize how easy, not good, but how easy we had it back then, because you could just say, sign here and get an appraisal. We didn't even, sometime I say we, it wasn't me. Sometimes they didn't even require appraisals. So literally they just pulled your credit and that could be marginal and you had your house. You could close. That was the other thing. You could close 3 days later. So they tried to do that in a way that sort of made it so that people didn't really truly have time to go look at what they just signed. So it was just slam and jam. And what they would do on those kind of loans is they didn't really ever do 30-year fixed. What they would do is they would do what's called a 228 arm, which meant the rate was actually fixed for 2 years or sometimes 327. So it was only fixed for 3 years, but then there was a prepayment penalty for a full 5 years. And the prepayment penalty was generally 4% of the balance. So if you borrowed $200,000, your prepayment penalty was $8,000. And so after 2 or 3 years, your payment was pretty much going to double. And the only way you could get out of that is if you had $8,000 sitting around in the bank. And none of those people are the type of people that had an extra $8,000 in the bank to buy out of their prepay.
Right. And so there comes the foreclosures.
Yes, exactly. So then a large percentage of the U.S. lost their house in 07, 08.
Well, and there was another issue there. You talked about the negative amortizing loans,
Arms.
and there were a lot of loans out there that were a 30-year amortization, 5-year balloon, interest only loans, right?
Oh yeah. Yes.
So I have a acquaintance, I'll call him that, who made a very foolish decision, and I told him at the time that he was absolutely nuts. He decided that he wanted a bigger home than what he could really afford, and because it was a 30-year amortization, we got 5 years of interest only. He went and bought $1 million home.
Right.
Okay, and let's call the interest rate 5%. So he's got $1 million home.
With a cheap payment.
With a really cheap payment.
Arbitrarily and temporarily cheap payment.
Now, he did this in 2006, okay? And it wasn't until late 2007 and into 08 when the defaults started happening on a lot of the subprime loans. And that's what you were alluding to there a few minutes ago. Those were the subprime loans, right? And so now all of a sudden we have all these defaults on the subprime loans, which leaked into the prime loan market and then ultimately started collapsing the value of real estate. So this guy's house that he bought in 2006 for $1 million, the 5-year balloon came due in 2011. All right. Now, all the lending standards had changed. The laws had changed. What the banks would do and the lenders could do had changed.
Right.
And so
to the conservative direction.
Yeah. So what happened was his 5-year balloon was up. And so that meant he either had to pay the $1 million off, or had to refinance.
And it wasn't an ARM; it was a balloon.
It was a balloon.
So the balance is due after 60 months.
Right. So if he doesn't pay it off, he's got to refinance.
And so because he's been making interest-only payments, he didn't pay any principal balance down.
Right.
And then because of all the defaults that happened in the last 5 years, values went down because every default in his neighborhood sold for half price or pennies on the dollar.
Yes.
And so then the way appraisals work is they say, what have your neighbor's houses sold for? Well, they probably sold for $600,000 or something.
Exactly right. That's the number, $600,000.
Exactly. And then, so then by comparison, his house is worth $600,000, which is probably less than he owed on it because he probably borrowed.
He borrowed $1 million.
Yep.
He didn't put any money down.
Right.
There was no money down.
That's
5-year interest only balloon. Right. So he owes $1 million. The house is now worth $600,000. Oh, and guess what? In order to do this refinance, you got to put 20% down, 20% of the $600,000. So now he's got to come up with $520,000 in order to stay in his house.
Exactly.
And he didn't have anywhere near that kind of money. And so those kinds of things, they snowballed on each other.
Exactly right. 80% of 600,000 is 480.
Yeah.
And so he owes $1 million, and they're saying, we'll do the refinance for you if you pay it down to 480. Well, like you said, 520,000. If he had 520,000, he might have put that down in the first place.
Right.
All the time.
Right.
Yeah. So, that's my fear right now about, like the difference is in 07 and 08, the good news and the bad news is Congress got significantly involved in regulating our business, which meant that they started doing licensing. They started doing like sort of a barrier to entry in terms of you got to pass tests, do continuing education. It used to be a long time ago, 30 years ago, that, okay, you want to be a lender? Start tomorrow morning. Here's your desk and here's your phone. And now, it's not incredibly hard to become a lender, but you have to do 20 hours per year of continuing education. You have to do a background check. You have to pass tests for every state and also the national. And at least it's something. In addition, they pretty much outlawed the liar's loans.
Yeah.
I don't know if it's true to say that they're illegal, but they're pretty close.
Right.
Which they
Well, they should be.
Yeah.
Right?
Yeah.
They should be. Because, people get in over their head.
Right. Easy. It's baiting people to get in over their head.
Absolutely. You remember the commercials, and it was whether it was on TV or whether it was on the radio. We'll loan you up to 120% of the value of your home, right? And people were like, I can get, I got a $500,000 home. I can go get $100,000, and
125s. Yes, second mortgages too.
Yeah. And that was just like, it was suicide. When I knew it was all over. Now this is going back a ways, right? So I still got the actual physical newspaper,
right? Yeah, nice.
And so I walked out into my front yard, and it was a cold December morning, I think it was.
Yeah.
And I take the newspaper back in, and I'm reading the newspaper. I open up the finance section, and there's a full page ad that you could get a free BMW with the purchase of a Pulte home.
It's pretty funny. Pulte home and give you a Beamer. Yeah.
And I told my wife at that time, I said, this housing market's going to crash. I said, this is insanity.
Yeah.
It's absolute insanity.
Yeah.
And that was December of 2007.
Yeah. Yeah, I believe that. That's crazy. That doesn't even surprise me. There was so much like money in it because, it was really like Wall Street type investors looking for, junk bonds and higher yields and much riskier stuff that was sort of hard to define what it really was, at the expense of quality underwriting and quality approvals.
Yeah. Well, they packaged all these securities up together, and then they sold them out into the market to individual investors, et cetera, as AAA credit.
Right.
And some of them might have been, but a lot of them were.
Some of them probably were fine, but for the most part, they were sold by, people that did not have their client's best interest in mind. They were just looking, and that was the other thing. Big commissions, the biggest of commissions were paid on these things. Like where a normal bank probably when they sell a loan makes 2 or 3% on a loan, these were 5 to 10% commission deals. So
I had no idea that was the case.
Oh yeah. So on a $200,000 loan, instead of making $5,000 or $6,000 when they sell it to Fannie Mae, the bank makes $20,000.
Wow.
Yeah, crazy.
Wow.
Crazy.
Well, thank God those times are behind us.
Yeah, absolutely. Me too. I agree.
And so really, I think, Tim, what I would really love to do here is to kind of peel back the layers of what goes on in the area of lending. And I'd like to start with kind of the basics, right? Some of the things that people really need to know when they're going to get a loan for a property, whether it's a house or an investment property or whatever. And I know the loan rules are different for investment property than they are for a house, but let's stick to just the house individually, right? What are some things that people really need to be aware of when they're going to go get a loan?
I mean, for the most part, mortgages are made to be sort of uniform, and that's a good thing because it makes them not dependent upon the mood of the loan officer or the lender that day. They're just based on the credit and the capacity to pay back and the collateral value, like the house value or the house condition, and certain things that you can put on paper and that you can sort of measure. So in other words, there's not really like, at least in our business anyway, in my part of the business, there's not too much of doing somebody a favor and getting them a loan. Maybe in some sorts of banking there's that, but in mortgages that go through Fannie Mae, they're pretty much standardized.
Sorry. So you've got the interest rate on the loan. That's something that you need to know about. And then you've got potential points on the loan. You've got closing costs. Are these things standard as well?
Well, among good lenders, they're pretty similar. Everybody sort of gets their money from the same place, which is called Fannie Mae. So everybody in accounting terms kind of has their same cost of goods sold of all the input costs. So, more or less all lenders have the same rates, at least within 0.1%. I sort of liken it to like if you want to go buy Apple stock. I don't say, Dean, what's your price for Apple stock? And then go to another financial advisor and say, what's your price for Apple stock? Because the market is giving you your price. In mortgages, the market is giving the lender their price or their interest rate also.
But the lender can also choose to mark up those rates for extra profit, right?
Yes. Lenders almost always do. And that's that 2 to 3%. And that's not 2 to 3% of
interest rate.
Interest rate. That's called servicing value. In other words, like getting the interest over the life of the loan.
So as you and I do this podcast, I think the 30-year mortgage is around 6%. And so if that were the standardized rate across the board, might you find a lender that's loaning it at 6.125 or 6.25 or something like that?
Yep. Or 5.875. And actually, it's interesting to think about, like in these times right now, 6% is about 3% higher than they were a year ago. But if you go back to pre-COVID times, 6% is pretty much the normal interest rate of what rates have been for the last 30 years before COVID, before the Fed started doing.
I think you were in the fives before that. But I mean, 3%. And I saw a lot of our clients getting under 3%, which was in my, I'm like, right. That's free money, man. I mean, that is free money.
Yeah. Even if you got to compare it to inflation. So even if inflation slows down as at 2%, if you're borrowing money at 2.5% and inflation is 2.5%, then you're really not losing
Right.
Not very much anyway. And it's tax deductible a lot of times.
Yeah, absolutely. So talk to us about how the points work on a loan. So you can like buy the interest rate, you can pay that lender to lower the rate.
Yes. Points are basically, it's called discount origination points. Pretty much a slang way of saying paying money upfront to the lender in exchange for getting a lower interest rate during the life of the loan. So generally 1 point is 1%. And so again, say you're borrowing $200,000, 1% of that would be $2,000 in extra closing costs. That's just fee income to the lender. In exchange for that, they might offer you a 0.25% lower interest rate. So if the rate's 6, you pay 1 point, which is $2,000 extra up front. They would charge you 0.25% less. So your rate goes from 6 down to 5.75. And then you just sort of got to think of it in cost benefit terms of I'm paying $2,000, I'm saving, $100 a month because of my lower interest rate. And so after 20 months, I'm better off with the lower interest rate. Before 21 months, I'm better off with the higher interest rate, but with $2,000 extra in cash reserves. And so then you just got to evaluate it based on how long do I really feel comfortable that rates are going to be like this? Because if rates are going to go low before your break-even point, then don't pay the points. But if this is like a couple of years ago when people were borrowing money at 2.5% or 3%, and if they were never going to move, that's probably their forever 15, 20, 30-year loan. And so it did make sense to pay points a couple of years ago, whereas now we're likely to go back over the cliff and get cheaper rates at some point. So
at some point, the economy goes into a recession from where we're at here, then we could start to see rates come back down again. I think honestly, where we're sitting at 6%, Tim, I think rates have got higher. They're going to go higher before they start to go lower.
Yeah, I have heard from a couple of different economists that like the Fed, they're probably somewhere around their main goal is to push rates up to 8.3, maybe even 8.5%. And it's sort of a race to push them up, in my opinion. They keep bumping the Fed funds rate, which is not the same as mortgage rates, but it sort of trickles down. So they keep bumping up the Fed funds rate like 0.75 per month. They're probably going to do it again. They're probably going to do it again in November, December. And at some point, we're probably going to have 8.5%. The Fed's main job, as you know, is to control prices, to not let inflation get too high or not too low. They want it to be around 2 or 2.5%. And so the ways that they can do that is they can control the rate that banks borrow money from the Fed, like in the short term, and they can also control the money supply. And so right now they're raising rates, and they're also selling off some of the treasuries that they bought in the last couple of years in order to increase the money supply. Now they're selling them, which means they're giving the treasuries back, and they're getting the banks and the big investors money, which basically means that they're taking money off the street and then they're going to hold that, which lowers the money supply. Those two things make less money out in the world, make inflation slow down.
Which could also lead to a recession.
Most likely, yes.
Yeah.
And recession, in my world, I look at it different. If you go look on the charts, like in the last 30 years, almost every recession has been a boom in the housing industry. Because if you think about it, when we're having a recession, really we're talking about, is the recession affecting your job and your employment and your ability to put food on your table and take care of your family? And if you have a recession and if you feel really good about your job, it's an excellent time to buy a house, because probably rates are cheaper. There's probably a little less competition for the houses because some people got laid off, and it's an excellent time to buy a house because of those two reasons.
So let's talk about somebody that's a first-time home buyer. They're out of college. They've saved up a little bit of money. They're in their mid to late 20s, maybe 30 years old by now, married, going to start thinking about having kids, tired of want to get out of the metro area, get out of the suburbs. We want to buy a house.
Move out of mom and dad's basement.
Yeah, that too. I've got one of those right now.
Right, exactly.
So I always like to tell people to put 20% down, but that's not necessarily something that has to happen on that first-time home purchase.
If the 30-year-old first-time home buyer has 20% down, great. Or if their family has the ability to gift them money for 20% down, also great. I sort of think of it like put as much money down as you can and really get a cheaper payment, or put as little money down as you can and do something different with your money. Don't get stuck in the middle. A lot of times, in my opinion, it doesn't make sense to put maybe like 7 or 8% down, because that's just using more of your money. Every $1,000 that you put down on a house only lowers your payment by about $6. And so $10,000, which when I was 30, that was a lot of money. $10,000 only lowers your payment $60 a month. So if you have a $1,500 payment, you're still going to have a $1,440 payment, and you're going to be $10,000 broker.
But your payment's going to be higher if you don't have 20% equity in your home or the 20% down, because you have something called PMI.
Yeah.
So that's something I think confuses a lot of people. So
Okay.
can you explain PMI?
Yeah, PMI, private mortgage insurance, sometimes it's just called MI or mortgage insurance now, is basically like back in the day, you had to put 20% down to buy a house. So the government came out with PMI, which is basically default insurance, which just insures banks that if they do a loan for less than 20% down, and if then it defaults, then the government, the PMI, the insurance company, will step in and insure them up to the first 20% of their loss. And that 20% of loss insurance is basically intended to be, foreclosure costs, lawyer costs, if the house is torn up, so they can fix it up, so they can sell it. And it just basically makes it so that banks can still feel safe making low interest rate loans with less than 20% down.
So what's the cost on that? Because that's, I think, is it a percentage of?
It's usually a percentage. It's usually like, 0.3 or 0.32 or something. Generally speaking, it's $100 or $200 a month. So
Right.
it's a deal. It's not a small deal, but it's not a killer either.
Right. So if somebody has the 20% down and they can avoid paying that, let's just call it $150 a month.
Yeah.
That's $1,800 a year.
Right.
Over the course of 10 years, that's 18 grand.
Right.
That isn't going to anything other than that
Right.
mortgage insurance.
What happens most of the time, especially in the last, 10 years when houses have been appreciating, honestly, overall houses have appreciated, 3 to 6% for the last 30 years. But as houses have been appreciating, you might buy a house with 5% down, and then loan to value is what we're talking about. It's the loan amount divided by the value. So if you put 5% down, you're at 95% loan to value. As you pay it down a little bit over 2 or 3 years, and also as house prices continue to appreciate, it's pretty common in 2 or 3 or 4 or 5 years to just automatically have 20% down,
Right.
even though you haven't paid it down the full $40,000.
So in order to get the PMI removed, then nobody's going to come in and just say, "Hey Tim, you're
Right.
20% loan to value."
Yeah,
So-
the
or
PMI
80%.
insures. The PMI is kind of a crazy thing because it's what the consumer has to pay, but it doesn't insure the consumer. It insures the bank. So almost never the bank is going to call you and say, "Hey, guess what? We're going to lower your payment by $200 a month, and we'll take the risk." So what you got to do is you just sort of got to pay attention to it. Or what we do is we send out a anniversary email and sometimes an anniversary phone call when we think you're getting close, to just say, "Hey, I think you're getting pretty close to being at 80% loan to value with 20% equity. And if you want, I'd be happy to help you do a 3-way call to your current servicer, or at Guild, we service all of our loans, so we would still have it. So I would just get on my computer and take care of it for them and make their PMI go away." And at that point, it's a pretty easy process. We send them something, say, "Print this, sign it, email it back to me."
But don't they have to get an appraisal done?
Sometimes not.
Okay.
Sometimes not. Fannie Mae has almost every house in their system. Fannie Mae and Freddie Mac are these they're called GSEs, government-sponsored entities. And they're private companies that are funded or sponsored by the government. And so they sort of set the rules on that. And most lenders on 30-year fixed, almost all lenders, are lending that money with Fannie Mae-backed money. And so every time somebody buys a house, your loan goes into Fannie Mae's system. And so does your neighbors, and so does all their neighbors. And so they have sort of like online AI-driven appraised value. So they can say, "Yeah, your house is probably worth," so say you need 400 to 450 for you to have 20% equity. As long as the amount you need is within the range that Fannie Mae thinks it is, then most of the time they can just drop the PMI off.
Interesting. I don't think people really understand that. And
Right.
I think there's a lot of people out there that may be in a position where they're still paying that PMI,
Right.
and they don't even know that they can call and get it removed.
Exactly. And you can do all this without having to refinance. A refinance is just getting a new loan that pays off the old loan. And certainly if rates go low again in a year, refinancing would make sense. But if rates go high and you have 3 or 4 or 5%, although a relatively low interest rate, you may not want to refinance. You may want to just leave that there, make the PMI go away, and keep on with your 28-year loan.
Interesting. Yeah.
Yeah.
Yeah. Yeah. Because I do know that there are a lot of younger buyers that don't put the 20% down. And I don't
All the
think,
time.
I bet there's people out there that are out there right now that have more than 80% loan to value or less than 80% loan
All
to
the
value.
time.
And they still have the PMI on there.
When in the last couple of years, because of COVID, the government was trying to push mortgage rates low to keep the economy sustained. And so we did quite a few refinances, more than we've ever really done. And it was astonishing to me how many people had 20% equity and were still paying PMI, because it just sort of lulls you to sleep. You just kind of forget about it.
Yeah. Great gig if you can get it. Just keep collecting from millions of people.
Free money. Yeah. Just go to the mailbox, get your money, go back in.
Yeah.
Nice thing.
All right. Well, you taught me something here today. I'm sure all of the people watching us on YouTube or listening to us on the podcast are going, okay, so if you know somebody that you think that maybe they didn't put 20% down, the people share this video, YouTube video or the podcast, whichever you're taking this in on and because that's a big deal.
Yeah. Or just have them call me. I mean, that's really the easiest way. It's just,
we'll have all your contact information in the show notes and in the link in the YouTube video. So people will be able to get in touch with you to talk to you about it. So I think we mentioned that refinances are a 20-year low, which is not surprising, obviously, because we've been in a very low interest rate environment ever since all the stimulus happened with the Great Recession, and then the dust off of the stimulus package and inject it full of some steroids, and we'll throw that out as the COVID rescue package.
Right, exactly. Yes.
And so
free money.
The people that have bought a house in the last, call it 10 years, they're not going to want to refinance right now because the rate's probably going to be higher than what they've got.
Probably not unless there's they wouldn't want to refinance to just lower their rate or their payment, at least. So if they're going to refinance, it's going to be some extraordinary circumstance, like they just actively need money.
Right. But for that, a home equity loan would work, right?
Almost always, yes.
Yeah.
Yeah.
Talk to us a little bit about home equity loans and how do those work, and can you open a line of home equity that you don't actually borrow from unless you need it?
Yep. I have one on my house. It's a nice thing. There's a home equity loan and there's a home equity line of credit, often in the industry abbreviated as a HELOC, home equity line of credit. So a home equity loan, think of like a car loan. You get it, you pay it off, you're done. A home equity line of credit sort of operates on a revolving basis, more like a credit card operates. So you get it, you use half or all of it, whatever you need. You pay it down, you can use it again. You pay it off, you can use it again. They generally stay open for 5 to 15 years. And the downside to home equity lines of credit, there's two downsides to it. One is that they generally only bill you for the interest only as your minimum payment. So you pretty well need to pay at least a little bit extra. And that's usually a pretty easy calculation for a lender to say, just, here's your 15-year amortization, pay a $50 or $100 extra a month. And the other thing is they're generally not fixed interest rate loans like 30-year fixed like the first mortgage is. So as the Fed keeps raising or hopefully lowering prime, more home equity lines of credit rates keep going up also.
Okay, so you got a variable rate, but if somebody wanted to say, hey, just as an opportunity fund or a emergency
rainy day
type of a scenario, and they open up a home equity line of credit, doesn't mean they have to take any of that money out, right?
Oh yeah, it's an excellent thing.
So it's almost like a checkbook.
Yes, exactly. In fact, mine did come with a checkbook. You just get it, and if you need $30 or $40 or $75,000 because your roof needs replaced, or you need to buy a car and you don't have time to go through the car loan process, or whatever you may need money for, most of them they come with a checking account. And you just log on online, transfer $30,000 from your line of credit to your checking account and write a check, and that's your loan. And a month later, you start making payments.
And so if somebody were going to do that, how would they know what the current rate was going to be on that loan?
I believe prime is 6.25% right now. And generally those are prime plus a half. They're prime even to prime plus a half. So 6.25% to 6.75%.
Okay. So if somebody were going to go out and buy a car today with their home equity loan and it's 6.25% or 6.5%,
right?
Probably wouldn't want to do that because you can get better lending standards from directly from a bank for a car loan or a credit union or something like that.
Yeah, GMAC would give you 3% or something, but sometimes in the short run, or if it's for a used car, or if it's for a trailer or something like that, sometimes it makes sense. And if nothing else, like it's nice to set one up, and then if you ever need one, it's there. Another nice thing Another reason to set one up, probably a more relevant reason in my world, is because it preps you for when at some point in the future, when you go to buy your next house. It's a funny thing. People always come, and we do lots of purchase money mortgages. People always come and they say, I love this house and I'm never moving. And then 5 years later, I say, hey, you're buying a new house because they had a baby or two babies, or they outgrew it, or they found their dream house somewhere else. And the problem is, when you have equity in your house, the problem with that is you have to sell your house to get your money. Like, you have the same net worth maybe, but you got to sell your house where you live. And it's often hard to coordinate buying and selling. So
they may have to put a contingency in the purchase
Right.
of the new house that says, hey, we'll buy yours, but we have to sell ours first.
Exactly. And being contingent on the sale of your house means more risk to the sellers, who means they may not accept your contingent offer if somebody else shows up with the same sales price and a non-contingent offer. And so if you have a home equity loan already set up from 3 years ago, then you just write yourself a check and you have your $50,000 ready to put down.
So you put that money down. Now you have two mortgages.
Yep. So then you sell your house, and instead of getting $100,000 in equity out of the sale, you maybe only get 50 because you already got the other 50 out for down payment.
And then do you take that other 50 and you put that on the new loan that you just got? Can you do that, or do you have to then go through and do a refinance?
All the time, yes. So what I normally advise on that is, if your initial down payment equals 20%, then a lot of times it does not make sense to take the rest of it and put even more down. Sometimes it does because people just want a cheaper payment, but a lot of times it makes more sense to maybe call you and ask you what a better use of the money is. But sometimes when people do a home equity line of credit, like a bridge loan for down payment on the new house, they're only going to have enough equity in their old house to put 5% down up front. So then when they sell their house, they put the other sale proceeds down, and they either make the PMI go away or they make the PMI be reduced.
Okay.
3 or 4 months later, not waiting 3 or 4 years.
That's an interesting idea, Tim. I hadn't really thought about having that home
it's
equity
called-
line of credit in place in case you decide, hey, we want to move. So now I've got the money to put down, so I don't have to worry. It doesn't have to be a simultaneous transaction.
Yeah, no, I was just saying to someone in my office before I drove over here today that we should just get everybody to set one of those up. Generally, there's no closing costs for getting one, and they're generally open for 15 years, and we could make our life sort of a lot easier if we would just get everybody to do it 2 years ago. Because what normally happens is somebody finds a house, and then we wish we had done it 2 years ago, but now we're scrambling to do it right now.
Right.
Which, when you're buying a house, there's a lot of moving parts to that, and the less stuff you can have to worry about, the better.
All right. So that's really fascinating. I think that, anybody that doesn't have a line of credit, they should probably just set one up. It doesn't cost anything to do it, right? And you don't have to take any money out.
Most of the time, banks that do home equity lines of credit will say, if you open a free checking account with us, because that's really what they want. They want you to be a bank customer. They use a HELOC or a home equity line of credit like a loss leader to get you to open a checking account. And hopefully you'll do your banking stuff with them and do a car loan with them someday. And so, generally, as long as you'll do a checking account, there's no closing costs. And there are closing costs. It's just the bank will pay them for you, which is usually about $1,000 savings.
Okay, cool. So on that, let's stay on that subject for just a minute, because I had a couple more questions.
Yeah.
What's the limit on the amount of the home equity loan?
Oh, yeah. Most of the time, they'll go up to a total of 85% of what your house is worth. So I'll do this math in my head. If you say you owe 500,000 times 0.85, whatever that number is, subtract what you owe on it, and that margin between 0.85 and what you owe is what they'll do the home equity line of credit for. A lot of banks will cap you out at 250 or 350,000, like on really large houses with lots of equity.
Right.
But still, 85% combined loan to value with your first mortgage and the new second.
Okay. So then if somebody's putting 5% down, they're not going to get a home equity line of credit because they're not going to qualify.
Exactly. Right.
So you've got to have more
Yes.
than 15% equity in the house before
Right.
you can even think about
Right.
getting a
Yes.
home equity loan.
Once you get to 20%, it's a great idea to set one up.
Yeah.
Or if you put less than 20% down after a year, generally for the first year, a lender on one of these has to go off the lesser of two things, either the appraised value or the sales price. So after a year, you don't have to go off the lesser of the two. You can just go off the appraised value. So if you buy a house for $300,000 and then house prices go up 20%, that means it's worth $360 next year. So you can act like it's worth $360. Before a year, you have to go off just the $300,000.
And so does that come from the same Fannie, Freddie deals where
Sometimes. Normally on those, you just get an appraisal,
Okay.
and the bank pays for that most.
How much
of
does
the
an
time.
appraisal cost?
$465 almost always. Sometimes if it's a little further away, like they'll charge a trip charge of $20 for driving to the far parts of town, but usually $400 and some dollars.
Okay, but the bank pays for that.
On HELOCs, yes. Yes. On a normal Fannie Mae purchase, that's part of your closing costs.
Okay.
On a normal Fannie Mae purchase, like a 30-year fixed, then there's probably between $2,000 and $2,500 of actual closing costs. And by closing costs, I mean the one-time costs that are associated with buying a house, like title work, appraisal, cost of the credit report. You have to get a flood cert from FEMA that says your house is not in a FEMA flood zone, so you have to buy FEMA flood insurance. All those sort of things equals $2,000 to $2,500. The reason I say that much of a variance between $2,000 and $2,500 is because of the appraisal. Because if you don't have to get an appraisal, closer to $2,000. If you do have to get an appraisal, which we're probably seeing appraisal waivers on 8 out of 10 purchases right now.
Interesting.
Yeah.
Why is that?
Fannie Mae has a big database. They know what everybody's house is worth. They know what, at least when you bought it, you probably got an appraisal on your house, and that probably got uploaded to Fannie Mae at some point. And then they're tracking that, and they're tracking all your neighbors, and they know how many bedrooms you have. Big data.
So what happens on this, Tim, if somebody's done some home improvements, they've put on like a sunroom or something like that.
Mm-hmm.
They've improved the landscaping, or they redid a bathroom or a kitchen or something like that. How that can't be known. So if we think that increases the value of the home, in that instance, you'd actually have to go get an appraisal.
Yeah, exactly. When you get an appraisal waiver, that doesn't mean you're not allowed to get an appraisal. It just means that the lender calls the customer or the client and says, we don't have to get an appraisal if you don't want one. It's probably easier to not get one because there's no risk of a low value or of a condition or a repair to be noted. But if the client or if the lender and the client sees a reason to get an appraisal, then you just order an appraisal, and it takes about a week, and then you know really, really, really what it's worth.
Yeah, but I can think of an example where that might make some sense for somebody. There are a lot of kind of DIY people out there that are going to buy a house, and they say, okay, this thing needs, this different work. Well, I can do that work myself. And so over the course of a year or 18 months, they've revamped the house, and it's really worth a lot more than what they purchased it for.
Oh yeah, especially with finished basements, things like that, where maybe you finish your basement, put a rec room and a bedroom and a bathroom down there. And then all of a sudden, instead of having a 3-bedroom house, you've got a 4-bedroom house. And when you're comparing to other 4-bedroom houses, you probably have higher sales prices, and thus by comparison, higher appraised value.
So that's another way that a person could put a little bit down, put some money into the house, then remove the PMI by getting a new appraisal.
Yeah, if you bought a good house without a finished basement, hypothetically, you could put 5% down, pay cash for the rehab cost of putting a fancy basement in, and then get a new appraisal 6 months later and say, now with my finished basement, now it's worth $50,000 or $100,000 more than what it used to be before it had a finished basement, because it compares to larger houses basically, and make your PMI go away.
Interesting.
Yeah.
All right.
Yeah. It used to be that PMI was tax deductible. Like, I don't remember when, over 15 years ago. And that, like a lot of deductions, went away.
Yeah. A lot of our deductions have gone away.
Yes, for sure.
We get this new tax form. It's just, write down how much you make and send it in.
Yeah, exactly. All of it.
Feels like that's where it's going, doesn't it?
Yeah.
All right. So let's say that, so you talked about tax deductibility there. So on the interest on the HELOC, is that tax deductible? I know you're not a CPA.
Right. I was going to say, what I literally would answer to that if you were talking about yourself is I would say, sometimes it is, sometimes it isn't. Here's Corey's phone number. Call him and ask him.
All right. Go on. And by the way, people that don't know Corey, he's our director of tax here. All right. So let's move on to somebody that has maybe lived in their home for 10, 15 years. They found that next house and they're getting ready to move. I know kind of the standard thing is, let's take all the equity that we have on our existing house and let's put all that equity into the new house.
Yeah.
Do you see that that's the case most of the time?
This is happening so much. And it's funny, I'm 51. So back 15 or 20 years ago, we were all 31 years old or 36 years old, and we were all buying our first or at least our middle house. When people start getting to about 50 or 60, that's usually, I think, when people buy their big house, and they may not live there forever, but for 10 or 15 years, people live in their largest house then. And they probably bought their old house and then it appreciated and they paid it down some. And when they go to move, then they, have a large chunk of equity that they could, if they wanted to, use for down payment, which is exactly what most people automatically default to thinking. And sometimes that's the best choice for them. But frankly, what I advise them to do, especially if they're your customer, is to talk to you before they make any final decisions on that.
Right. And in the last, I would say, really up until 2022 here, as we do this podcast, I would tell people, don't put all of that down because what I said earlier, you have free money. When interest rates were down there at 2.5%, 3%,
Right.
Hey, let's put the 20% down. Let's take the other 20% of equity that you had and let's invest this. And because
I just always call it a mortgage offset account. So if you have an extra $100,000 that you could invest in the stock market or do something else with it, or pay off your house and pay off a 3% loan. If you pay off your 3% loan, then minus the tax deduction, that's probably like paying off a 2.5% loan.
Right.
Or you could invest it. And so you really just got to say, can I make more than 2.5 or 3% in the market?
And you got to judge that over a period of time, right? Say, give it a 5-10 year period. Yeah.
Mortgages last for 5 or 10 years. So why not look at this 5 or 10 years too?
Yeah.
In addition, you're liquid with that money the whole time. You don't have to sell your house to get your $100,000 if you ever need it in case of emergency. And if you get 4 or 5 years down the road and you say, I'm tired of having this mortgage, I could just pull it out of investments, pay off my house. You can still get the same thing.
Yeah, no, I think that's interesting, Tim, because what you don't want to do is say, I got this extra $100,000. Let's go buy a new Tesla. Right. You want to make sure that you keep that money so that at any point in the future, if you want to put that back towards the principal of your home, you can. Don't just think that's free money to go spend.
Right. Especially on something that depreciates like a Tesla.
Right. Well, all cars, well, with the exceptions of the last couple of years, even used car values are going up. That's crazy.
Yeah.
I know we've been talking for a long time, and hopefully we've shared some really good information. I do think that, you got a lot of different types of mortgages out there. You've got an adjustable rate mortgage. You've got a fixed rate mortgage for 15 years. You got a fixed rate mortgage for 30 years or even 20 years.
Yeah, they generally go in the fives. So 10, 15, 20, 25, 30.
And the rates will vary for all of those. Whether you pay points or whether you don't pay points, that's going to vary your rates. How much you put down, how much should you put down.
Yes.
And people have a lot of different choices. And what I don't think people understand, and you get it because you and I have had a lot of conversations, that choice is a financial planning choice. It shouldn't be a choice about just the house itself, because the choice that you make there can drastically impact your ability to either get to or through retirement.
Yes, especially with a lot of people that I see, even affluent people that make really good money, just not having enough cash in the bank for retirement, or cash in savings or retirement accounts in their 401k for money. And sometimes if you have an extra big chunk of money from the sale of your house, you can invest that money and significantly help out your big picture, long-term retirement picture. And the house rates are still low. Even if rates are at 5 or 6 or 7%, then you're still going to borrow that money incredibly cheap.
Here's an idea for you, Tim, and this is something that's come up a lot over the last, I'll call it 20 years. I've been helping people get to and through retirement for 35 years now.
Yeah.
It seems like a long time.
Crazy.
But I've had several clients over the last, call it 15 years, that have said, "Hey, Dean, we're thinking about a second home. We'd like to have a home, whether it be Arizona, whether it be Florida, Texas. Maybe they want a summer home in Wisconsin or Michigan or something like that."
Yeah.
And then last the question, can I afford to do it? Well, the first thing I have to remind them is that having two homes is going to be really nice. If you're 65 years old and you have two homes, it's going to be really nice for the first 10 years. You're going to be okay going back and forth. Maybe it's 15 years, but by the time you get to about 80 years old, it's like, okay, one of these places has got to go, because number one, I don't want to make the trip back and forth, twice a year, and I don't want to take care of two places anymore. And so
double maintenance, double lawn mowing.
Right. So what I tell people there is, here's what we're going to do. We're going to buy that second home, but we're going to take out a 30-year mortgage on it. And we're going to get the lowest rate that we can.
Yes.
Because chances are that you're not going to have it for 30 years.
Right.
Right. And when you
Right.
sell it, you'll regain your equity and anything that you paid down. So that's an area where I really think people need to talk to you. They need to talk to me. We need to work together in order to say, all right, what's this number going to look like? And then we can build that into the financial plan and make the right decision.
A lot of times people come to me wanting to buy a second home in Florida or someplace like that. And they initially say, well, I think I can afford it if we do a 15-year loan, barely. And I say, yes, you can. But if you do a 30-year loan, then your payment will be $500 higher a month. And you can save that $500 per month, which will make you have less equity, but more actual physical savings, which will make you have the same, in theory anyway, the same net worth, and you're liquid the whole time, and your house is going to appreciate. The fallacy is that houses appreciate whether they're paid off, paid down, or not paid down.
Exactly right. The real estate's going to do what the real estate does.
Right.
And when you're in retirement, it's 100% about cash flow. How much money can I spend each month after my obligations? It's all about cash flow. And so structuring a home loan or a loan on a second home going into retirement is really, really critical to think about it purely in terms of how do I get the most cash flow, the most free spendable money after I've paid that mortgage.
It's a funny thing. Like people always ask, what's the interest rate or what's your interest rate when they're thinking about buying a house. But then I can tell you from personal experience, going forward, I don't ever think, do I have a 30 or a 20 or a 15, or do I have a low interest rate? I just think, well, here's my payment amount, and I write the check.
Right.
So like really, initially, much gets made out of what the interest rate, but in the big picture, nobody really cares. Everybody just cares about what the payment is. Yes.
It's about cash flow.
Yep. Affordability and cash flow. And are you comfortable with your payment?
So let's say somebody comes to Guild Mortgage and wants to talk to Tim Kay, and they are saying, "Hey, Tim, I need to get pre-approved. I'm going to buy a house." What is the amount of lead time that you typically like to see in order to make sure that that person makes the right decision and gets the best deal?
Oh, well, let me just kind of tell you the process, and then I'll kind of tell you the lead time on that. So if you called me and said, "I want to buy a house. I'm thinking about my lease is up. I'm a first-time home buyer. My lease is up the end of October, in a month or two," then I would say, well, then pre-approvals last for 90 days. And so let's go ahead and get the process started now, even though you're maybe not buying a house for a few more weeks. That way, if something needs to be worked on, like sometimes people will have, something on their credit that they had no idea about, maybe a medical collection or something like that. Almost always that isn't the case, but if it is the case, you want to have time. You can fix all things like that almost always if you have time to do it. And so I would generally email or text the link to do an online application. And, tonight when you're at home in front of your laptop, you type in where do you live and where do you work and where do you bank at and your birthday and all that loan application boring stuff. And then you hit submit or finish. And then it comes to me, and tomorrow morning I work through it. And then I send you a text or an email back saying, I've looked at it. Everything looks great. I'm ready to talk when you are. And then you call me. And then after we talk for a minute, I generally send out the pre-approval letter. So the actual work time is probably 20 or 30 minutes.
Okay.
But the process is like a day usually.
Right. So somebody doesn't need to say, I'm thinking about buying a house in a year. Boy, I should go talk to Tim right now. They need to get closer to making that decision.
Not unless they're worried about something, Okay.
Like
if they were thinking about buying a house in a year, I would say you may want to think about buying a house now because prices are going to be 5 or 10% higher next year. But aside from inflation, which we've already talked about a lot, I'd say call me, in 6 months or 8 months when it's closer.
Okay.
Yeah.
Tim, this is great information. I really appreciate you joining me here on the Guided Retirement Show. And anybody that wants to talk to Tim, there will be a link to Tim's email and website and all that through a link in the show notes. Or if you're watching us on YouTube, it'll be in the notes below.
Yep. I love talking about this stuff, so feel free to call anytime.
All right. Thank you, Tim.
You're welcome.
I hope you enjoyed my conversation with Tim Kay. We finished up there and I said, Tim, we just talked for 50 minutes. He said, it felt like 10. The guy knows exactly what he's talking about when it comes to mortgages. If there is anything you need, obviously, you'll be able to find a link in the show notes to get in touch with Tim. And before you actually make that decision on what you do, make sure that you're talking to one of our certified financial planners here at Barber Financial Group as well, so that we make sure that it fits best into your overall financial plan. Don't forget, we're offering you access to the same financial planning tools we use for our own clients. Just get out to the link in the show notes and click the Start Planning button and begin your retirement plan from the comfort of your own home.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Barber Financial Group and SEC registered investment advisor.